Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Oh, good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Oh, I got a cough here. Hold on. All right, so it is Thursday. We have jobless claims coming up. Today is going to be a weird stream because I have a dentist appointment. So my plan is to just leave the stream going while I go to the appointment, and, you know, just so that we have the order flow recorded for posterity. But if I take a trade today, it's going to have to be quick in and out early on, sort of a thing. Now, also, I want to point out, yesterday we ended with a trade, and after the stream, that trade really took off. I did hold it to basically like 40 ticks, but after holding it, I realized that I took it on the wrong account and it was not a live trade. And so I just wanted to note that because I thought it was a live trade at the time and I don't want anybody to accuse me of like being deceptive or anything. That ended up being a sim trade, unfortunately, which sucks because it was like a $40, $50 trade. All right, so let's go to the charts now. Okay, so you can see here in ZN, after our session, they just right up there. And a little bit higher today. Hold on just a second. That was weird. My wife came in and checked on me, but she didn't like actually come in to say or anything. She was just like looking at me. All right, anyways. So we are slightly higher in the overnight when we're waiting for the news here. It will probably be pretty big news when the jobless claims come out. S&P 500 pulled out a win yesterday because the news was basically the job market is not as crazy as the job openings reflects. So oil continues to come back here, and it's actually declined significantly. And I do think that some geopolitical developments may be coming in here that maybe prevent us from going into the $100 range. Maybe this was all a great time to go short oil. I don't know, but it's come back pretty aggressively. Gold and silver, oh man, they're still reeling, but you know what? They've found a place. So I'd actually say that gold and silver have weathered things pretty well, considering how much yields and so forth, real yields have moved. So coming over to Bitcoin, nothing too terribly interesting. I hate it when sometimes it won't show me the tab down at the bottom. Okay, and the dollar did come back considerably yesterday, and we are back into the lower end of 106. Now let's come back over here. Let's talk about the news. So first of all, it is a Thursday, so we tend to get a decent amount of activity on Wednesdays and Thursdays. The big news we got coming up is U.S. initial jobless claims. Previous reading of 204K, and this week we expect that to be a little bit higher at 210. We will also be getting U.S. trade balance, which is expected to come in at negative 59.8. So trade balance is usually not a huge number, but it does affect currencies, and currencies have been one of the big drivers as of late. So we've got to keep an eye on that. All right. All right, so we got 30 seconds. How fast does Financial Juice release the data? They're pretty good. Okay, so initial jobless claims is slightly lower than expected at 207 versus 210. So that's going to be a slight drag. And the U.S. trade balance 58.3 versus an expected at 59.8. Okay, so neither of those are like blockbuster numbers. The initial jobless claims being slightly lower than expected is bad, but it's only by 3K. That's within the range of error. So we might get a gentle little sell-off here, a little bit. But at this point, we have to consider what the larger flows may be. Yesterday, the flows were very much tilted to the upside. And I see evidence of that in cumulative delta and the flow this morning. So with this little bit of a move to the downside, we have to be weary of the possibility of meta orders long and short covering like we did yesterday. But the speculators are still out there, so like it could still go either way. That's tough. That might just leave me without a trade because I don't think I can trade off of that flow that we just had there. Yeah, so Financial Juice gives you the data live. I mean, I don't think that there's any other place that you would get the data faster, or if you did get the data faster, it would be like by a second or something like that, right? There's some of the places that you get for free, you know, you're going to be like 15 seconds after the news until you get it. Like with me, because I'm telling it to you, and then there's like a 15-second delay or something. So, but the Financial Juice has also a lot of other cool things. Besides just the squawk, they have, you know, a really good board that shows you what's coming up and what the expectation in actual is. You can set up alerts so that when the number comes out, it will give you a sound based on whether it was above or below. That's really cool. They also, Financial Juice also has other services. For instance, they have a price squawk sort of a thing that will like make sounds when there are big buys and sells or interesting activity in the market. They also have an unusual activity scanner thing that will alert you to stocks that are having unusual options activity and so forth. So they have a lot of cool stuff. And then their main screen just gives you a really good overview of what's going on and what's important, etc. Donald Trump's lawyers asked to postpone the classified documents trial until after 2024 election. Biden administration reverses course and clears the way for a new border wall by waiving environmental laws. Well, that would be interesting. Okay, so it looks like they're chilling out. Maybe coming out. No. As soon as I start to think about it, it comes back down. There seems to be a bit of a hole here between 01 and 03 for the time being. Okay, now don't let me forget, my doctor's appointment is at 9:45 Eastern time. So we got an hour and then I got to get going. But I'll keep the stream going. But, you know, I won't be here to talk in your ear and bother you with politics and so forth. Interesting. So I don't know if I can read this one to you. This is a premium story from Zero Hedge that is relevant to us. The recent move in rates has been historic. As noted earlier, we have seen a 73 basis point rise in the 10-year U.S. yields during quarter 3, while 39-year yields soared 8.9 basis points. This staggering parallel shift resulted in huge unrealized losses on banks' fixed income portfolios, and which, according to the Deutsche Bank calculations, will reveal another 140 billion in unrealized losses, pushing the cumulative total to a new record at or above 700 billion. That's so much. Of course, there's a simple scenario in which banks don't suffer any losses. All that what it take is for yields to tumble right back down to where they were 3 months ago. That, in a nutshell, is a thesis published by JP Morgan's head of rate strategy, Jay Barry. I've never heard this guy before, who overnight calculated that 10-year yields at 4.68 appear 30 basis points too high based on JP Morgan's fair value framework, which represents the biggest such gap since October 2022. And since there's a strong case for adding duration, providing market expectations remain stable for Fed policy, inflation, and growth, the JP Morgan strategist recommends that JP Morgan clients buy 5-year treasuries. Okay, so based on the trade that he's talking about here, I think that playing it in the 2 or the 5 would make the most sense because we are still continuing to see steepening. And I do think that there is a good chance that we could rise a little bit. But I think that we have to put a big caveat on here because JP Morgan has pretty much been bullish rates like this whole time. Like, if anybody was buying against this huge rise in rates that we've had over the past 3 months, it was probably JP Morgan, right? So I would put that one out there first. The second thing is that they are making a fundamental case, and we need to remember that the market is not fundamentally efficient. So I am not convinced that this rise in this rise in interest rates overall is actually a fundamental play. I think that there are maybe a lot of technical flows involved here. And it may be the case that those technical flows continue through in spite of what the fundamentals may suggest. And maybe they go back to the fundamentals eventually, but how do we know if it's going to happen today, right? So, okay, so let's just read an excerpt here. We recommend adding longs in 5-year treasuries. Immediate treasuries appear more dislocated relative to their fundamental drivers since October of last year, and positioning is more neutral than it's been since this spring. The treasury market has yet to find any stability as long end yields rose 14 basis points and the broad curve steepened by 10 basis points. With this move, 30-year yields have risen 75 basis points since the end of August and are now trading at their highest level since August. Taking a step back, 10-year yields have risen 100 basis points from their local lows late July, and this move is on par with the other idiosyncratic moves to higher yields that occurred over the last decade, including the taper tantrum of the 2015 Bundavar shock and the fiscal expansion-driven move in the fall of 2016. Okay. Notably, this move is quickly approaching the magnitude observed last year, which was driven by hawkish Fed and the UK LDI-driven deleveraging. Oh, yes, I forgot about that. In its current form, with policy rates significantly more restrictive than this time a year ago, the other DM central banks nearing their conclusions of their tightening cycles, it's not likely long-end yields move another 50 basis points from current levels. But to be fair, not many had predicted the magnitude of the move that occurred over the last 6 to 7 weeks. Okay, so this is kind of interesting that they are saying like this move is a little bit exacerbated. The thing I'm concerned about is that I'm starting to be concerned that there might be some reflexivity involved in here, right? Because if the treasuries go much higher, you're gonna and the cheapest to deliver switches, then that's gonna push a lot of selling into the treasuries. And I thought that this number was relatively tame. But they're selling this pretty hard here in the treasuries right now, aren't they? So again, I come back to it seems like there's something else going on here that nobody has been able to really, get a handle on yet. I haven't seen any analysts give me a satisfactory answer as to what's driving these flows. Open ZB UB, go long ZB, short UB Well, but why would you want to do that one when you could just sell UB and buy ZF? Why not go further on the curve? Has that one really been working ever since 2020? Wow. Obviously, there's a point at which that stops working, right? But I see where you might be coming from. Is like the steepening in the curve on between the 30 and the 20 has been consistently steepening for a long time. Interesting. Oh, we may have gotten our first little reprieve here. I don't know, man. That selling was a little bit more than I would have thought. I would say that since the news, we've had between 5 and 10,000 net contracts short. It was more extreme in the 30-year. We did get steepening again, but relatively low amount, a low amount of volume in the 10-year relative to how far it moved, in my opinion. So I don't know if I need to freak out about that yet. Again, like, I'm concerned that we don't 100% understand what the flow that's coming in that's pushing them this way. Maybe it may just be like things related to Japan and that sort of stuff. Gold is getting hammered here pretty hard. It is rare to see yields move by this magnitude over a short period of time before petering out. Decoupling between yields and fundamental drivers is reaching historical levels as well. Market-based Fed policy, inflation, and growth expectations have explained more than 95% of the variation in 10-year yields over the last 5 years, and on this basis, 10-year yields now appear approximately 40 basis points too high. After controlling for their drivers, yields are more than 2.5 standard deviations above their model implied fair value, the largest gap since this time last year. Well, I don't know if I really have that much confidence in your model, but it sounds like it's okay. Thus, this magnitude of deviation would indicate that Treasury yields would need to correct lower at some point, or market-based Fed inflation expectations would need to rise considerably to justify this move. Finally, it's worth noting that position technicals, which were in our minds a significant contributor to this move to higher yields, are incrementally becoming less of a driver here. Our latest Treasury client survey released earlier today shows that net longs declined to 5%, the fewest since mid-April, and our client survey index also moved to its lowest level since mid-April. Accordingly, the survey index is now modestly shorter than its prior year average. Recall, we have found that our client survey has consistently given contrarian signals on the direction of rates when positions move sharply away from average levels. Basically, JP Morgan is warning that there could be a massive short covering rally in the treasuries, right? Yeah, term premium is likely to increase further from current levels and in turn should result in steeper curves and the 10-year sector underperforming along the curve. Accordingly, we prefer to add exposure shorter along the curve and recommend adding longs in 5-year treasuries at current levels. It really seems to me like there's very good reasons to play the curve here. Like, basically everybody is long steepeners, right? And if we are seeing this sort of a move, like the thing that we're doing right now, it is absolutely to our advantage to play it over here in the 30-year. I don't know if I could convince anybody to fill me over here, but we got to start trading the other instruments, guys. You know? Oh, now that's interesting. They're talking 20, 30-year steepeners too. So here's their trades. 5-year duration longs or initiate 20-30 steepeners hedged with 10-30 flatteners. So they're talking about a butterfly trade there, but it's still steep on between 20 and 30s. Yeah, it does look like they've built out a decent little hole here. I don't know if it's going to reverse, but we are at a very, very interesting time in bonds. We've kind of been talking since the spring about this time of year, and it's not disappointing. It's not disappointing so far. It's been hard to trade, I will admit, but the volatility has been there, and it's been interesting. FedEx says that my chair is supposed to come today. So if it doesn't, I will be... Oh, no, it's totally coming. Oh, yeah. They have it in North Salt Lake. It'll probably come earlier in the morning. I would be so very unhappy if I didn't actually get it today after they tell me that it's going to come. Dude, getting a new office chair is like one of those seminal events in computer geek, events. But getting nice chairs, you only have so many nice office chairs in your life, so getting a new one is like a big deal. It's a big new era for us. It's a new era for us. We'll have the blue chair. These days, the dollar and the ES has been very... Oh, yeah, totally. Well, the thing that I think has made this market so difficult for me to trade is that we're largely trading the dollar. And, I mean, I can kind of make some guesses about the way that the dollar is flowing, but the dollar seems to flow differently from the treasuries, and it's a different play. We just don't have as much edge in the dollar as we do the treasuries, And I don't know if there's anything that we can do or look at that would give us that advantage or kind of, at the very least, kind of even the playing field again, So it's basically turned everybody into dollar traders. This is a little frustrating. How far back should I go with historical data have stat significance? I know you usually say 5 years, but given everything that's happened in the last 5 years, is it enough? Well, okay, so from a pure numbers perspective, if I have a normal distribution, you need about 50 data samples to be able to construct a decent curve and have relatively good, relatively reasonable confidence in the statistics that you're getting. But we always have to consider that markets are fat-tailed. So that's the first thing, is the more fat-tailed the thing that I'm looking at is, the bigger the data needs to be. So if I'm looking at something that tends to, like the range of 5 minute of a candle in the ES, right? The vast majority of them are only within 4 points or something. It's probably changed now, but it used to be 4 points. We'll do it in the treasuries, okay? The vast majority of them are 4 ticks or less in ZN. So that's a very, very fat-tailed distribution. So if I'm doing some sort of a study about the range of a 1 minute bar, I need like thousands, if not tens of thousands of data samples, right? And the more fat-tailed it is, it goes up exponentially. So if you get something that's much more fat-tailed than that, you basically get into an area where there's just like no way to get enough samples. Okay. But so where that puts us for most like retail trading strategies is about 1,000 trades. Somewhere between like 600 and 1,500 trades is where you would want to go. Now, usually 5 years will give you that, right? But there's another side to this, two other sides to this. One is that the industry standard is 5 years. So like if you can't show a 5-year history, are you ever going to get anybody to invest in your hedge fund? Like unless you can show like the theoretical performance of it or something, you know, that's what people would expect, right? But then the other thing is that the market's changed. Yes, the market's changed, and so I can't just say, "Oh, well, it worked in this past year," because the market's changed so much. Now, there are going to be some strategies that only work for that 1 or 2 year. If you're going to do a strategy like that, though, you have to have a very effective qualifier to say, this is why this trade is working in this environment, and this is what would change that would make me not want to trade this anymore, right? Basically, you need to have a filter to tell you when to trade it or not trade it. Okay. Can you go more than 5 years and go out into like 10 years? For sure. But, you know, if you're looking for something that is like, you think that it's based on the structure of the market and it should be relatively consistent, then 5 years will probably get the job done. But just keep in mind, the reason why we have to do 5 years is because that gives you a wide enough array of different types of markets to trade against in order to do things. Now, another side is that from all of my research, if you're trading intraday, trying to find some sort of a technical setup based on price and whatever on 1 minute bars is crazy hard. So if you're going to be trading a technical thing on intraday, it probably needs to be centered around some sort of a relationship, correlation, etc. Right? Otherwise, you may just be reading noise. But so it seems to me that the kind of like analysis that we're constantly trying to do with our back tests is probably more likely to yield us results on daily bars. But that presents a different problem, because now if we're going to do a proper back test on daily bars, you know, we probably need to go back like 50 to 100 years of data, right? And I don't have access to that. So I think you will find almost always that like what you need, if it's like really seems like it's a really good strategy, what you need to really prove it almost always seems to be just barely out of reach for the retail trader. You only use technicals on daily or weekly levels, like, yeah. There is absolutely, I don't think that there's any predictive value in it, but there's absolutely significance to like previous days' highs and lows. The market absolutely reacts to them. I can't necessarily predict if they're going to reverse or continue through them, but whichever way it plays out, you will see more interesting behavior around that level. You see it rotate around that level, bounce at that level. Like the market is definitely, people watch those levels and are reacting to them. So I think that there is a pretty strong case for, you know, previous day high and low to be psychological levels that the market reacts to because of people in a similar way that even numbers tend to have lots of liquidity at them. But yeah, once you get into small time frames, it's got to be correlations and order flow. And that's a key point. And one of the things that I'm trying to point out, and maybe I should just present it like this, is that order flow alone is not enough. You have to look at correlated instruments, because a correlated instrument could move and cause the market makers to adjust their prices and cause moves on very little volume, and you're going to be like, what the heck is happening? Because this would happen to me all the time. Is like, it would come down to a level And I'm like, oh, it's going to break through that level. But then there's like massive absorption there and it doesn't make it and it bounces back up. And so you're like, okay, maybe that area of support, something like that. I don't know. Then it comes down again and like nothing happens. There's not a whole lot of volume or anything. It seems like there's just not interest in it. And so it bounces. So it's like it bounces if there's support there. It bounces if there's not interest in them selling it. Then it comes back a third time and there's nothing crazy. There's not like tons of volume. There's not tons of market sellers or anything like that. And it just slips through unceremoniously. And you're like, what the heck? Why did the buyers not come in this time? Why is it going down even though there's like hardly anybody selling it? There's hardly any volume. Well, it's probably because of a correlated asset and people are trading the correlated asset and not your asset. If you're not watching the correlated asset, you're not going to see that happening and you're not going to understand why it's doing what it's doing, right? You're watching all the correlated assets. You know the things that may potentially be moving those and everything. Now you can kind of understand it. And that helps so much from a risk perspective, because if the Japanese yen or the dollar is doing something, your treasuries are going to probably move. And if you're not aware of it, very easy for you to make a stupid trade. And just adding that dollar index has made such a significant difference to my trading. Like that alone, I think probably got me to like being break even most of the time, because I was able to avoid these dumb trades where it was like, it seems like it should go here, and then it would just like slip down lower up for no apparent reason. Now I can look at the dollar and I can kind of see, oh yeah, it looks like they still have some room to go. Like on this situation, would not count out the possibility of them breaking new highs here now, because if you look at the dollar might want to retrace this whole thing, right? So you can kind of make guesstimates like that. The dollar's indicator that we have, and same with the spreads and all these other things, they really all do have like a reason, a purpose. It's a complicated thing, but you sort it out eventually. Is it like John Grady's follow the leader strategy? I think that's a little bit different. But because isn't John Grady's follow the leader more of a spread trade anyways? I haven't seen that kind of behavior in a little while though. Like sometimes there will be days where somebody really wants to get filled on a trade over, like maybe in the 30-year they really want to buy and they're not getting any fills. And so they'll do this funky thing where like they'll sell down, or they'll pull their bid over here in the hopes that it will drag this other one down and they'll get their fills. So he has one trade that's like that, and there's another one, I forget what the setup is, but that's what I think Jiwi is talking about. Basically, we're typically looking at like one instrument and saying, okay, like what's going on here? Well, there's a lot of liquidity in trade going on here in the 0403 half area. But the cumulative delta has flipped 10,000 contracts long now. Could break those highs. But then we also kind of have to do this analysis across the spread too. Well, they're buying the 5 and they're selling the 30, so we're getting steepening. And sometimes there can even be things on a tick by tick basis where you kind of see like, oh, this instrument really wants to tick up, but it can't do it yet because this one isn't going yet. For whatever reason, they don't want to bid this one up. And so you kind of get to this, you kind of start to learn where it's like, okay, I'm not going to see a tick up until I see a bigger bid on this one or something like that. And then you can kind of get setups based on the whole curve. Not to mention that, again, we should expect on the upsides, we get more on the 5-year, and on downsides, we get more on the 30. So, you know, like right now on this trade, the better trade would have been to be going long the 5-year rather than long the 30. So that little move right there was a really good example. Do you see how the 30-year is actually 2 ticks above the 10-year? The 10-year is lagging, and it's being dragged by these other ones. Decent amount of volume going through on it. It may just be a short covering rally. That's not to say that it's not like a serious flow or anything, but that might be one of the things that's driving it. I think it's actually probably more than that. If it is really just a short covering rally, then probably what we get is a breach of the highs and then it chills out. But I bet you that it's going to be a little bit further than that. I kept looking around my room to see where the music was going. You know, we used to not play the music for the longest time, and now I can't imagine doing things without it. It just feels weird when I don't have the music going. 5K iceberg at 05 half, and they just blew right through that one, man. So I'm gonna try the level break here, all right? I don't know why that one didn't hit. Okay, there you go. I should have pulled that. I was gonna try and up it, but it didn't happen too fast. But that was an easy 1 tick. They did a little bit of a squeeze, like they put a big bid there, trying to squeeze, but it's kind of been a little flaky. And you see these bids that they're stacking. Kind of suggests that it's more than just a short squeeze, right? A lot of these really, really big meta order players, like the biggest ones, like to add liquidity when they're executing. So if we start to see a move and I see strong bids behind the move and the overall liquidity is increased, that's usually a very good signal for a trend. Now, I don't know about the placement because you just saw there I got 1 tick, but it's already below where I had gotten in, right? Because I took it from 06. So that kind of suggests to me that we might be able to get a better spot. We're almost back to 472, which again was the price that we were at before all the zaniness on Tuesday. Interesting. There's a Bloomberg story I think we're going to try and read here. Older millennials on track to retire more comfortably than late boomers. A report by Vanguard says changes in the retirement industry will help younger workers afford more in retirement. Millennials often worry they'll never retire. Turns out a lot are better situated than baby boomers. Yeah, because it's not like baby boomers did a bang up job with this, is it? That's according to a Vanguard retirement readiness report that found older millennials across most incomes are on track to retire with a closer level of income to spending level needs than both Gen X and late baby boomers. Millennials are facing higher education, housing, and healthcare costs and are less likely to enjoy the same level of Social Security benefits and income from a pension. But changes in the way retirement funds are drawn and invested are putting millennials between the ages of 37 to 41 on track for a more comfortable retirement as measured by Vanguard Group. Sometimes I wonder when I read like stories like this, I'm like, am I the only 37-year-old millennial out there? Because these always just exactly match me. Maybe I'm just too basic. Because I'm on track for a good retirement. Okay. Investment management company gauges retirement readiness by comparing projected income against expected spending, both as a percentage of pre-retirement income. For example, the 70th percentile of wage earners, those making a median income of $61,000, workers are estimated to need about 68% of their annual salary once they retire, but only millennials in that income bracket were close to meeting the projected level of necessary income. They are on track to have a sustainable replacement rate, as Vanguard calls it, of 66%. Meanwhile, late baby boomers, those ages 61 to 65, had a rate of 51%, and Gen X had a rate of 53%. I bet you that the younger ones are not, though. I think that what's happening is the older millennials were able to get into the market early enough, to get like those 401ks and stuff. And the ones that were a little bit younger had a harder time getting in, and so they weren't able to start as early, is what I think happened, but I don't know how you would prove that. Vanguard attributes millennials' brighter outlook to changes in the retirement industry, including a push to automatically enroll workers in plans, default more workers into defined contribution plans at 5%, automatically increase the percentage of pre-tax salary deferred each year, and make diversified target date funds widely available. Still, across most incomes, there is a gap between what is saved and needed. Vanguard, whose replacement rate analysis largely didn't take into consideration home equity, said that gap was likely to grow across all generations as well if cuts to Social Security benefits materialize over the next decade. 32% cut, for instance, would reduce each generation's sustainable replacement rate by about 10 percentage points, with those earning less seeing a bigger hit, according to the report. I don't know. This move in ZN is kind of starting to look like, let's just retrace the move down. I'm not seeing at the moment yet the desire for them to push higher. And the big orders that were there aren't there anymore. Analysis was developed using data from the Federal Reserve Board Survey of Consumer Finances, along with data from the National Income Product Account, Federal Reserve's financial accounts, and the Society of Actuaries. So we need to get more millennials now from tier 2 into tier 3. So tier 2 is like you're investing in your 401k, and we want to get you to you're like maxing out your accounts. That's the end of tier 2. Once you've maxed out your accounts, you can start doing stuff in tier 3. And you don't have to like completely max out your accounts, but that's kind of where you're going for. But you can start tier 4 before that. Tier 4 is where you're like either buying rental properties, starting a business, private equity, which if you're super rich, most people can't do that, or investing in individual stocks. We would like to see more people invest in individual stocks, yes. Yes, if you invest in individual stocks, you may not perform as well as the S&P 500. But if you do outperform the S&P 500, you could outperform it by a considerable margin, because you could get one stock that goes like 20x. And as a regular person, you actually have a pretty decent chance of catching those. The risk reward is worth it. You're 19-year-old Gen Z. The media loves to talk about the difference between generations so much, but I'm continually finding the media like totally getting it wrong over and over again on things that like I can objectively show. Like, for instance, they say Taylor Swift is evidence of society's decline. Her influence among Gen Z, this is a bad thing. It's going to be bad things for society, etc., etc. Because these Republicans are mad that she's getting a lot of people to sign up to vote and stuff like that, right? Taylor Swift is not a Gen Z icon, guys. You can go and look at her audience. She has a very broad audience, but only about 11-15% of her audience is Gen Z. The largest section of her audience, which is like 40 to 50% of her audience, is single millennial women. Then you get to go into the there's going to be a lot of single millennial. They're going to be millennial mates. Yeah, Karen. I'm trying to coin the term. I haven't seen this anywhere else. Wait, let's do a Google search. Millennial maids. Yeah, I'm not seeing a whole lot. So I think I can take credit for the term. There's a large assortment of millennial women that will never get married and never have children. And it's something like 50% now at this point. Now, you can have kids well into like 45, so we're not quite there yet. But yeah, there's going to be a lot of them, and I'm calling them millennial maids. Millennial old maids. There's going to be a lot of them. Deceived women. So, I talked about there's 4 levels of investment. Okay, right? First level is you're not investing at all, right? We want to get you out of that and into contributing to your 401k as quickly as possible, right? Once you get there, then the next thing is, and you're maxing out your employer contribution, which everybody should do. Okay. Then we want to get you to maxing out your IRA, maxing out your 401k contribution completely, contributing to 529 accounts. Those are like all of the tax advantage accounts, right? And then you get into tier 3, which is where you're going to be having rental properties, investing in individual stocks, maybe private equity if you're lucky and you get a good opportunity, like you're given the opportunity to get into something like that. Or starting your own business. That's tier 3. Tier 4 is thinking about the societal level investment. And everybody should think about tier 4 because everybody should be investing in tier 4 in one degree or another. And so the question is, where should we be putting our investment? And this comes down to all of these tiny little decisions, right? So, really, I think the way to think of it is that investing is an art. It is. So what makes something an art? Well, it's creative, which means you're making something and there's tons, like possibly thousands of tiny little decisions that make it, that go into the thing, which means that everyone and the difference between two people making that thing can be great. 2, is that it's something that there's a skill involved in it. So you have to develop a skill and do the thing. And then the third thing that makes it art, and the thing that would kind of differentiate art between a lot of other things, is that it has meaning. There's supposed to be meaning behind your art. So like if I go and I make a painting, if I put paint on a canvas, but it's just a random assortment of nothing, that's maybe not necessarily art, especially if like anybody can make that image and duplicate it or something, right? But what's the reason behind you doing it that way? And what were you trying? Why did you do it that way? That's where you're injecting meaning into the piece and it becomes art, right? Well, our investments do have meaning, right? Our investments are a reflection of our beliefs about the world. We invest in the things that we should be investing in the things that we care about. And so investing can be art, right? And when I think on the societal level, I think that one of the best investments that we can make is in teaching that our arts to the next generation. See, what has happened is there are people out there that think about level 4. There's actually a lot of people that think about level 4. And what they said was, okay, the most important thing for us to do level 4 is a diversity, equity, and inclusion, is what they said. Okay, well, those are all good things. I disagree with the way that a lot of people want to go about doing that. Okay, but those are all good things. But focusing on those hasn't seemed to done people a lot of good, has it? Another group of people say that the most important level 4 investment that we can make is on climate change, right? That the Earth is going to be destroyed. Well, that temperatures are going to go out of control is going to have big negative impact on us, and so we need to reduce our carbon emissions and all of these sorts of things, right? Okay. I don't think that that's it. I mean, I'm not saying that we shouldn't protect the environment and make it clean. I don't think that that's where our level 4 investment should come from. I think that level 4 investment focus should be the same level 4 investment focus that humanity has had throughout all of its history. And that is on the people, and particularly the people of the next generation. See, we've been taught, or we've kind of been fooled into saying we shouldn't invest in people, because the more that we invest in people, the more that that's going to accelerate climate change. This is just an insanely stupid strategy, right? It takes people like 60, 70 years to die. Okay, so by the time you solve a problem like climate change with population decline, it's too late. Right? Because the things that they're telling us about climate change are like, this is the next 10 to 20 years, although it's already been 20 years. And I digress. It doesn't solve the problem. And meanwhile, what are you doing? You have less people to solve the problems, and they're all of the problems associated with demographic decline that Western nations are starting to see. So that's why I say the most important investment that we can make is in teaching our children our arts. These are these things that require a great amount of skill, and there's thousands of tiny little decisions that you make along the way that determine how that work is made, and most people can't appreciate it. If you go and I'm making this table, nobody's going to care about this table other than me, because they didn't make it. They don't understand. They can't possibly understand everything that I had to put into and all of the decisions and stuff that we made in making that table, right? Well, if you never teach those kids how to do those sorts of things, then they're never going to have that stuff. They're never going to understand it, right? And our investment is one of those arts. So, like, if we're on level 3 and we're doing pretty good on level 3, then we need to consider, how can we teach our kids the investing? And if we don't have our own kids, how are we going to teach other kids? Like helping the next generation I don't think it's about indoctrinating them in school. It's about thousands upon thousands of little details. Like, all of the big problems have been solved. You know, it's going to be the complicated problems that we have to solve. And in order to do that, they have to be able to understand the whole system, a whole work, and all of the decisions that go into that, and how can we make better decisions to make a better work. Yeah. Investment is not all investment is art, but when we're doing level 3 investing in individual stocks, I think that there's meaning in that, and that it does become art. So, back to the thing that kind of got me going on this. Yeah, we lied to a lot of millennials, and because we had the internet and everything, millennials generally had this idea in their head that I need to go and change the world, that I need to go and convince people on these big issues, whether it was politics and who you're going to vote for, or climate change, or whatever the deal is. And we completely ignored the things that we have the ability to have the greatest impact on. Having children and influencing your children, in interacting with your community and having an influence on your community. And every tiny little decision that you make does matter. And the better we can get at making those decisions, because ultimately building society is an art. Ultimately building a society is an art. And we basically completely ignored that art, and most millennials didn't learn it. Most Gen X didn't learn it. And so now this newest generation of kids don't understand that at all, don't even understand the society at all, and that's why you see them being so disrespectful to it. You know, like, if somebody goes and builds something like a business, think about that whole thing with Kyle, the guy that, you know, was attacked and shot 2 people, and that whole thing, right? He was defending a business. It was a car dealership, right? To these people, you know, it's there's no respect for it at all. There's no respect for what it takes to build a business. It is a piece of art to some extent, and it's somebody's whole life in building that business, and they have absolutely no respect for it because they don't know anything about what it means to create a community. Or when you have people that they'll just riot in the streets, they'll destroy, and some parts of these cities are just hollowed out. And those of us, especially conservatives, we find it very, very sad. I don't think they understand that, because they just don't understand that what a creative endeavor it is, and what it means to create. It's like a sacred thing, and we've completely neglected it, and that's resulting in the problems that we have. So because we said, oh, these big things matter more than these little things. But actually, these little things, because you have such an impact on those little things, and there's so many of them, and every single one of them matters, you can't, you know, those matter more than these big decisions. Right? It's just like the square root law. Right? Yeah, okay. 2,000 contracts will move the market more than 1,000 contracts. But the actual, like, impact per contract is less on the 2,000, right? Because it's a curve. There's a curve. That means that 1% of the orders can be responsible for 10% of the volatility, right? There's all of these tiny little decisions. You know, there's going to be one decision in there that ends up having, like, this insanely huge positive impact on everybody. And it could be, like, something incredibly trivial or that you wouldn't even think about, right? And we're so concerned about that we have to do everything big that we just completely passed over the biggest opportunities for us to have impact with just the people in our area and our communities. Super sad, right? We've got to convince millennials, millennials in particular, that we've screwed up and to pursue those sorts of things. I think the one that I advocate, I think the thing that will help you to understand and appreciate these things the most is to pick an art of some sort where you're actively making something with your hands. I mean, like, video editing is cool and doing all the stuff on the computer is cool, but I think you should also have a physical hobby. Like, I mean, there's so many, right? Like woodworking, leatherworking, metalworking, pottery, jewelry, you know, like it just goes on and on. Like, make something. It'll so change your perspective. And then once you know how to make something, teach your kids how to do that thing. Okay, we're gonna have another move up here. There was a pretty big shift in longs there, about 5,000 contracts again. I think that because it's about time for me to get moving, I'm not going to take a trade, but it kind of looks like that there might be an opportunity for another set. And yes, I think the group that we have to reach the most is millennial mates, because they might not have kids. Like, I don't know what's in the cards for a lot of these girls. They may never have kids now, right? But that doesn't mean that it's too late for them to start contributing more to building society. Don't just, you know, if you're a woman, yeah, I don't think there's anybody on my stream that's a woman right now. I mean, we have some, but there's usually only like one or two. My stats are like 99% men when I look on the YouTube analytics. But if you're a woman that's like a millennial, never married, okay, don't just sit in your house with cats and drink wine all day. That is a waste of your life. Go and make things and show other people how to make them. And build relationships with people in your community. I sawed 3 cubic meters of wood yesterday. Does that count? What were you doing that for? Wood is interesting. You know, I would never have picked wood, but apparently that's my family's thing, so now I'm a woodworker. Like, I started doing this desk thing with my uncle, and I found out how much my uncle knows about this, so I'm like, okay, I'm gonna learn. And then I found out that he kind of got it from grandpa, so apparently the thing is, in my family, is woodworking. For winter heating, I don't think that counts. Gotta make something out of it. Make a box, make a chair, make a table, make a... How far are they going to go? They really busted out there because it was at 08, right? This is a good move, man. No, fires. No, like a... Okay. So here's the thing is you want to make things that last forever if you can. So maybe you make a table. So I'm making a table, right? Okay. Will that table last forever? Well, probably not in that form, but like that piece of wood can be useful for possibly hundreds of years. It's already probably a pretty old piece of wood, and we're refashioning it into something. So, you know, in that respect, it can be permanent. The legs that I'm making, those are permanent. I mean, eventually, even if they throw it away, those legs are going to be melted down and turned into something else at some point, right? You should try and make things that are permanent. A fire is not permanent, right? You think about like the pyramids, for instance, right? I find it really interesting, some of the theories about why the pyramids were made. But you know what I think the most important thing about the pyramids is? They're there. We might not know 100% how they made them, but we know it can be done. And I think that that's a significant thing, right? So now all people will always forever know that it's possible to make something like that. We don't know why or how, but we know that it can be done. Okay, guys, so I have to go to a dentist appointment. I will leave the stream going, just to have things muted and have the camera turned off, okay? And hopefully we'll be back in about an hour. But or you probably won't hear much talking from me. You know, when I come back, I'll probably just end the stream. But appreciate those of you that stick around and watch things. We are getting quite a strong trend coming up in here. We should be running into the meta order impact here really soon. It might actually be there at 12. But this is looking like something that might have additional legs. So this is a pretty surprisingly strong move up here. In fact, does it change our volume profile chart from yesterday? Maybe. Maybe. We're still kind of like this point right here. So 14 is kind of the interesting spot, I guess. So we'll see what it does. All right, so if I don't see you again, stay excellent, team. Remember that tomorrow the non-farms payroll is going to be a monster news release. So All right, I'm back. Let's see here. Did anybody stick around? Oh yeah, it looks like most of you stuck around. Well, so what did I miss? It looks like, yeah, right when I left, things kind of petered out, but it looks like the meta order is still out there. I don't know if there's much more we can get out of it, but it does look long. The way that this one is executing, though, that kind of looks more like a speculative trade to me. Like maybe these are the JP Morgan guys buying, you know, like their clients, like in the research and coming in and buying the treasuries here. If Tuesday was a market chaos, Wednesday was chaos on a trampoline on drugs, says Zero Hedge. Barclays shocking verdict. Only a stock market crash will stop the bond bloodbath? What? That's super bearish, ain't it? There's no magic level of yields that, when reached, will automatically draw in enough buyers to spark a sustained bond rally, the analyst noted. In the short term, we can think of one scenario where bonds rally materially if risk assets fall sharply in the coming weeks. They think the sell-off has been driven by two factors. First, markets are adjusting to the notion that policy rates could be elevated for a long time. And second, the term premium has risen considerably because of the worsening in the U.S. fiscal situation. There is a little chance that the Fed will suddenly stop QT, and even less of a chance that it will restart QE. Moreover, it would be counterproductive. Monetary policy would suddenly turn far less restrictive while the economy is still growing above trend and inflation is still far from 2%, a recipe for higher yields. The only way the Fed could help longer yields is by hiking so aggressively that markets are convinced a recession is imminent and rush to buy longer rates. But that is extremely unlikely, as well as the Fed is simply likely to stay the course and don't bank on economic weakness saving the bond bulls. Bond bulls waiting for weak data to come to their rescue are likely, we think, to be disappointed. Eventually, near 8% mortgage rates and U.S. long bond at almost 5% might weaken the economy considerably, but not quickly enough to help the current bond market. For most of the pre-COVID decade, treasuries had a price-insensitive buyer in the form of the Fed, as well as large current account surplus economies rolling their surpluses into U.S. Treasury holdings. Those days are over. Not only is the Fed now a net seller, but net buying from the official foreign institutions has also slowed. We believe the eventual path to bond stabilizing lies through a further repricing lower of risk assets. Absent that, there's no sustained bond stabilization, and given how risk assets are finally responding to bonds, no stabilization in risk assets either. We believe stocks have a substantial room to reprice lower before bonds stabilize. It's definitely, yeah, okay. And Zero Hedge's own point in there. It's interesting. Yeah, that one yesterday was on Sims. I mean, it's not the end of the world, but I was pretty pissed. Okay, so I think I'm probably going to shut down here in about 5 minutes, because I have a meeting too. I know, today is weird. Today is a weird day. Dum-ba-dum-ba-dum-ba-dum. You're not missing out anyways. Market non-convictional chop until non-farms payroll. I don't know, man. Before I left, there was definitely a pretty strong long come through in the market. That's very interesting. So this morning, we've had two very conflicting reports. JP Morgan says that bonds are 40 basis points too high. The interest rates are 40 basis points too high based on fundamentals. Meanwhile, Barclays is looking at the macro framework, and they're saying that there's probably few things that can stop the decline in the bonds and rise in rates unless the equity market just there's a bloodbath. That's what they said. What was the terminology that they use? Only a stock market crash will stop the bond bloodbath. So these are very conflicting. The flow that we saw this morning was long. It did kind of have the hallmarks of one of those bigger guys getting involved, and it looks like they're actually still buying out there. It's just that because we pulled back so much and everything from the dollar kind of rotating back down. Yeah. Oh, actually, it was more the Japanese yen. So we could maybe still buy it, but that's just what's happening today, you know? So basically, we are now entering into a market that has a substantial amount of disagreement in it, right? You smell what I'm stepping in? We have a market with a substantial amount of disagreement in it. And then we've got this really big non-farms payroll tomorrow, which is just going to be... Whew. So a lot of, I would say, decent volatility, and tomorrow is going to be nuts. Our chances are we won't be able to take a trade tomorrow. That's, for me, it'll likely be just simply too crazy. I do kind of wonder, though. Well, let's come and look. I kind of wonder if maybe it's actually maybe for once we'll actually get one that misses expectations. What are they looking for? Last time it was 187, and this time they're looking for 171. Nah, I think that they'll come in really close. Well, just because there's not an agreement doesn't mean that you can't start to see conviction in price, right? It just it depends on how much money is behind it. And one of the difficulties that we're having is that we're a little bit unsure where the flows are coming from. But I think that Barclays has a better theory as to what's kind of driving these flows. And they're kind of more aware of the flows, whereas JP Morgan is trying to make a fundamental case. So I think that I'm more likely to side with Barclays, that these flows will continue to come through short, even if fundamentals don't suggest so. Well, guys, I should get going. I got a meeting, so I thank you guys for those of you that stuck around. Was an interesting day nonetheless. And I had some, we talked about some important stuff before. Stuff that, I want to talk about more. So I'll see you guys tomorrow. In the meantime, stay excellent, team.